I think institutions need to be very prudent, focusing on liquidity, dry powder. It's a time to protect capital, not to shoot the lights out to get some great return. There are going to be some great opportunities that come for this, but you have to be patient and you also have to think creatively.
Paula Volaent took a different path to learn the art of investing.
I was an artist and a scientist, not a finance person.
Volaent's career began in art conservation, working at institutions across the country, including the LA County Museum of Art and the National Gallery of Art in Washington.
I was running my own business and I realized I needed to know a little bit about finance because I was working with very expensive works of art.
Volaent attended Yale School of Management where she met David Swenson, the legendary investor managing Yale's endowment. He eventually hired her.
David looked at my resume. There was no finance at all. And little by little, I became incorporated into the investment office.
4 years at Yale led to Bowdoin College, where in 2 decades she grew the size of the school's endowment from $465 million to $3 billion. For the last 10 years, Volaent outperformed the investment returns of every single Ivy League school.
I'm very proud of the fact that Bowdoin could stay need blind and that we could enlarge the financial aid so students that could never dream of coming to a school like Bowdoin could come because of the endowment growth.
Last summer, Volaent left Bowdoin for Rockfellers University, one of the world's most successful research institutions.
I was thinking, you know, sometimes you need to be repotted. I've been here a long time, and it is the spirit of the Rockefellers in that there's art, there's beautiful gardens. It's a place to contemplate and to do good thinking.
So as we talk, the markets are in a bit of a free fall. Some might say it's a bear market, a correction, but whatever you call it, it seems to be something different than we've seen the last couple of years. So are you very worried that this is the beginning of a path towards a recession?
Yes, absolutely. I think it's interesting because I was reflecting on this the other day that whenever I start a new job, it's right before a big financial crisis. I started at Yale Investments Office right during the Russian bond default and the long-term capital. I started at Bowdoin, my previous job, in July 2000, right before the dot-com crash. And I just started 9 months ago at Rockfellers, so I think there's a pattern here. I originally thought it was going to be short-term because of the whole COVID and the supply chain issues and all of that. But then you have Ukraine, you have the Fed, you have inflation, which I thought was temporary, but now I think it's very much a long-term thing. And I do think we're in a bear market, which makes me manage a portfolio very differently than if we were in the, you know, in the bull market. We could have, you know, anyone could make money in that, but this is going to be a harder time to generate returns for Rockefeller.
So for Rockefeller and many other nonprofit organizations, they had a spectacular year last year. They had, you know, returns of 40, 50, 60% annualized rates of return. Do you think some of those returns are going to be coming back because now some of the great venture funds that were in are now going to have lower valuations?
Yeah, I think last year at Bowdoin, when I left in June, the fiscal year return was 59%. You had Washington University, which was in the 60s. These were once in a lifetime returns. A lot of it was driven by venture capital. Some venture capital on a dollar weighted basis were up over 100% over the 12 months ending in June. I don't think that's repeatable. It was an incredible period of time. I just had an investment committee for Rockefeller University this week. One of the questions was, what are the real marks on these private investments? As you know, private investments are lagged in valuations. And I think it's going to be this gradual write-down of these assets. I still believe in alternative markets, and I think there's going to be 2 problems for endowments. One, a lot of endowments use a smoothing rule for their spending. They use a 12-quarter moving average. Well, you're having all these great quarters, and so if you use that, take 5% of a 12-quarter moving average, you're going to be overspending. The other problem is going to be asset allocation. As the public market goes down, and the private alternative assets aren't marked to market, you're going to be way overweight in your private. And that brings up liquidity issues as well. And so right now, I think institutions need to be very prudent, focusing on liquidity, dry powder. It's a time to protect capital, not to shoot the lights out to get some great return. Right now we're in, I do think we're going into a recession, and that's a totally different playbook.
So let's have some optimistic news. Anything good about the economy you can think of?
Yeah, no, I believe into the entrepreneurship and the creativity of America. I think that there's some wonderful creativity that you have young people who are concerned about the environment, and they're, working on different things. I do think that eventually, I believe in capital markets and I believe in equities for the long run. And I do believe that are going to be some things that way overshoot, and there are going to be opportunities for skilled investors. I also think that, as Warren Buffett said, when the tide goes down, you see who has bathing suits on. I think we're going to see a lot of that, but there are going to be some great opportunities that come for this. But you have to be patient, and you also have to think creatively, I think.
So when you were looking at an investment, are you saying to yourself, I'm looking for the best manager I can find, and I will hire that manager, and if he or she is good, I stay with them forever? But if they're not good, I will get rid of them. How long do you give somebody before they aren't really going to be performing
we do
well?
lots of due diligence, and so it's sort of akin to what I did in conservation, where you do a lot of testing and work before you actually have the bravery of taking the drawing and sticking in a bath of water. You do a lot of testing. You also have a backup plan for something that goes wrong. I feel like the due diligence process of getting to know the manager, of looking at the sector, of doing comparison, of running analytics on the pattern of returns is something that can take a long time. And but once we're in, I am hoping that we're going to be loyal and in for a long time. However, if I've made a mistake and things change, it could be a change in the team, or it could be some really underperformance that I don't understand or that is unexpected. I want to always have the opportunity to change my mind. I do think that David realized that there were broad areas where you could find great opportunities to generate some attractive returns that were not traditional.
Endowments have changed a lot since 1638. That's when an English minister in America named John Harvard died and left his library of 400 volumes and a sum of £779 to a college established by the Massachusetts Bay Colony. In return, the grateful colonists called the college Harvard. Fast forward to 1985. The colleges known as the Ivy League led higher education when it came to endowments. But some would argue their investing styles really weren't that sophisticated. At Yale, David Swenson inherited a billion-dollar portfolio that was 40% invested in bonds and more than half in U.S. stocks. Over the next 35 years, Swenson transformed the ways colleges invested their money by focusing on reallocating assets into non-traditional asset classes. And Yale's endowment grew from $1 billion to $32 billion, even as it was making regular disbursements that allowed Yale to transform its campus. Swenson died in May of 2021 at the age of 67, but his legacy remains. Universities across the board have replaced dependence on stocks and bonds and moved into alternatives. Across all endowments in 2021, only 11% of holdings were in fixed income and 33% were in global public equities. The rest of the portfolios were focused on alternatives. Private equity and venture capital, 27%, marketable alternatives, 17%, and real assets, 10%. It's a mix that the endowment chiefs of the mid-20th century wouldn't have recognized. David Swenson was given the job of running Yale's endowment, I think when he was 31 years old, and he apparently managed to produce outsized returns for Yale, and maybe about $47 billion of returns overall. So it's a fairly spectacular track record, and you got a chance to work with him, is that right?
I did.
And you also, at Bowdoin, when you were managing the endowment of Bowdoin, which we'll talk about in a moment, you had a chairman of your investment committee named Stan Druckenmiller, also a pretty famous investor. So what was it like learning from David Swenson and learning a bit from Stan Druckenmiller?
They are both amazing teachers, mentors, and good friends. David loved to teach, and he would, no question was too silly. And also, if there was an acronym and you didn't know what it was, he wanted you to ask the questions. We also worked really hard. It was like working at an investment bank. You know, even though we were at a university, we did a lot of due diligence. We traveled. We wrote these big books for the investment committee, and he was really amazing. And then he was long range. He thought really long term. Then I came to work with, you know, and I had Stan, and Stan is one of the most talented investors in the world. And he's a very short-termism, you know, he's a macro trader. So the funny thing with Stan, he could give you a great idea, and then the next day you're like, oh, I don't think this is working. And he goes, oh, I sold that yesterday. So he's in and out, whereas David was really long thinking. And the combination of that, for me, was the basis of, I think, a lot of my success in the investment world.
So let me ask you, before we go back to your background, in the last 10 years at Bowdoin, you outperformed, as I understand it, the investment returns of every single Ivy League university for that period of time, including Yale. So what did David Swenson say to you when you outperformed him?
Well, I always remember first of all, we gave him an honorary degree to thank him for training me and all that, and he was very proud of that. Also, one time, and before that, one time he was in my office and he was looking over an analyst's thing and at my performance, and he's like, "You're outperforming Yale." And David was very competitive, but I showed you earlier, he wrote me the most beautiful letter with a quote from Leonardo, "Poor is the student that does not outperform the master." And David was very gracious. He was very proud of that. You know, he also was very competitive, so he wanted his Yale Cubs or Yale puppies, whatever they were, out there. But he was very proud of me, and he was just a wonderful friend, and I miss him.
So let's talk about your background. Where did you grow up?
I was born in Worcester, Massachusetts, and I grew up in a very lower middle class family. My father had severe dyslexia, so he only went to the 3rd grade in school. My mother was a housewife. She never went to college. And when I started, I went to a public high school, and then I started at Emerson College in Boston because some friends of one of my friend's parents convinced me that I should go to college. My parents really didn't think about college. And I ended up transferring to a state school, the University of New Hampshire, where I got my undergrad degree in art history with a minor in chemistry because I had discovered art history. Art conservation, which I later pursued.
You had intended after graduating college to be an art conservator.
I did. So what happened, I studied paper conservation, restoring prints and drawings. I worked at the New York Historical Society for a while there. I then went to work at the Palace of Fine Arts in their conservation lab, and then I went to Los Angeles, where I worked at the LA County Museum. I did scientific work at the Getty, and then I set up my own conservation studio where I worked with contemporary artists like Ed Ruscha, Sam Francis. And I was running my own business, and I realized I needed to know a little bit about finance because I was working with very expensive works of art. I was running a studio. And so I started taking a couple business classes at UCLA, and through that I got introduced to Yale School of Management, but I got into Yale School of Management at the same time I got offered a fellowship at the National Gallery of Art, where you and I both serve, the Leisure Fellow, and I worked in the paper conservation lab there, combining paper and paintings techniques for conservation on contemporary works of art.
So you did that for a while, then you went to Yale School of Management?
I did, and I had to take baby math before I went there because I was an artist and a scientist, not a finance person. My husband and I had been trying to have a child, and it wasn't going to work. So, you know, it wasn't happening. So he said, "Okay, let's move to New Haven." And of course, that was instant. And my daughter was born after my first semester, so I took a break. And when my daughter was probably 2 months old, I went to David Swenson and knocked on the door and said, "Hi, I want to learn about endowment because I'm going to work in a museum." And this is about David. David looked at my resume. There was no finance at all. And he took me in, and I started filing and helping organize things. And little by little, I got projects to do. I remember he had me do a big research on soft dollars. That was one project I worked on. And little by little, I became incorporated into the investment office.
So you went to work with David on his book, Portfolio Management.
Pioneering Portfolio Management.
Became a classic in the area. So when it was over and you finished writing the book with him, helping him write the book, what happened?
After the book got published by the Free Press, he asked me to stay on, and I came on the team, and I worked in various places. I worked on equities, I worked on stock lending, I worked on bond issuance, and that was in 1999, 2000, and that's like right when the .com, and we were doing lots of tech investing, lots of venture investing. We're trying to lock in our returns. It was a really interesting time, and I was fortunate to stay there.
So when did the Bowdoin opportunity come along?
So the Bowdoin opportunity came along because Ellen Schuman, who was previously at the Carnegie Corporation, she was a Bowdoin grad. But she mentioned to me that the Bowdoin had never had never had an investment office. They just had the CFO doing it, and they used Cambridge. And they were starting to think about bringing in someone to manage the endowment. And so she told me about it. My parents lived in Maine. I loved Maine. So I interviewed for the position, and I came in as associate treasurer, and I reported to the treasurer. Stan was the committee chair. And little by little, I sort of rose up the ladder.
So when you joined Bowdoin, its endowment was what size?
$465 million when I joined, and then it went down because of the .com crisis.
And when you left, what was the size of it?
It was $3 billion, and that's after spending. I mean, one of the things I didn't say about David is David was really about the mission. He could have worked anywhere and made so much money, but Yale was in his blood, and he cared so much about making money for financial aid. At Bowdoin, I'm very proud of the fact that Bowdoin could stay need blind and that we could enlarge the financial aid so students that could never dream of coming to a school like Bowdoin could come because of the endowment growth. People get caught up in a lot of these really quick money-making things and all that. I think in the long run for a person who has an investment portfolio or a retirement fund, they should be thinking in the long run.
Watching this and says, Paula Valent is a role model for me. She came from a modest background, got her degrees, worked with some famous people. Now she's running the investment endowment for Rockefellер University. I want to be like her. What does a person need to do? What do you recommend that somebody do to be prepared to have your kind of job?
Well, I think a lot of times it's serendipity and being open to something that comes along. Like, for instance, I was pretty brave to knock on David Swenson's door. I didn't really know who he was at that time, but I wanted to learn. I think a lot of times it's taking a chance.
But did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd put like a mosaic theory, put all these things together. I feel like I do that in my due diligence. And I think differently than a lot of my peers.
So let's talk about one area where some people say there's a bubble, and that's an area you might know pretty well, called art. Mm-hmm. As we're talking, there have been some big art auctions in New York where staggering prices were paid. I think almost $200 million for one Andy Warhol painting. Do you think there's a bubble in the art market?
I do think there's a bubble somewhat in the art market, but I believe that a lot of people are trying to put their money in hard assets that can appreciate over time, although maybe the Warhol, these are one-of-a-kind works, historic pieces of art. I think there's definitely a bubble in NFTs, which are a new thing in the art world. I think maybe a few of them will be very valuable, but I think a lot of it is speculation. I do think I collect art myself, and I collect art that I love, that I want to see on my wall, and some of it is very valuable. But I appreciate artists. I think art is a very important part of my life, but I do think some of the prices that are doing there are people who have a lot of money on the side and are trying to put it somewhere other than the market.
So let's talk about the best investment advice you ever received from anybody, either David Swenson or Stan Druckenmiller, or anybody. What's the best investment advice you ever received?
Was to admit mistakes, that's one, and also to be brave. I think like after March 2020, when you saw the downturn, then I wanted to make sure that after that managers were putting risk back on, and I think you can't, you have to be brave, and I think, and then from Stan, the risk management is something that is really key to how I think about management.
Now, you've seen investors who are professional and non-professional over the years. What do you think the most common mistake is that investors make?
Yeah, I think right now there's so much fast news, like you get news from all over the world, some of it different and all that. And I think there needs to be patience, and also people like the meme stocks and some of those things, people get caught up in a lot of these really quick money-making things and all that. I think in the long run for a person who has an investment portfolio or a retirement fund, they should be thinking in the long run, and they should have mutual funds mostly for, I always say don't do what we do in endowments at home, because you can't do some of the things that we do.
So let's suppose you're at a cocktail party in New York or Maine or wherever it might be, and somebody has told you manage the endowment for the Rockefeller University. They say to you, well, I have an extra $100,000. What should I do with it? What do you tell the average person who, for $100,000 might be a fair bit for an average person, what do you tell them to do with their money?
Well, right now I would say I think you need to wait a little bit. Don't dive right there in the market. But I would say do a diversified portfolio. You need to think about what your cash flows are going to be. Like at Rockefeller, the first thing I do every Monday is look at our cash flow needs, capital calls, spending, all that. I want to see what the cash is. So I would think you need to look at your liquidity needs. And then you need to invest mostly in mutual funds for smaller investments, because you can't get into some of the funds that we're in. And then also, different sectors can be very interesting, but a lot of index, S&P 500 to make you sleep well at night, not so well this time, but.
Are you an investor in cryptocurrencies, or what do you think of the whole crypto world?
Yeah, I do think the crypto world is something that's going to stick with us, and it's developing. I think that the blockchain is, it's sort of like when we thought computers, the first days of the computer, you thought only scientists would use it. And I do think it's an asset class. We are doing gaming, and we're also learning about the metaverse, which I think, some people think it's silly, but we're doing a lot of work on that, and we've made small investments in that to learn about it.
So you look back on your career, what would you say is the greatest piece of luck you had?
Biggest luck was just serendipity, all the great opportunities I've had, whether it be working at Bowdoin College in the museum to meeting David Swenson. There's a lot of paths in my life that I think were just serendipity, so I'm happy for that. I think one of the best investments I ever made was my beautiful house in Maine, which I love, Maine is in my blood. It's great.